The UK economy has stumbled with just days to go before the budget. This is Macro Matters, and we're talking the UK budget. Britain's businesses, consumer confidence and public finances all showed signs of weakness on Friday, just 5 days before we find out what's in Chancellor Rachel Reeves' red box. Retail sales dropped in October for the first month since May. PMI data showed the services and manufacturing sectors hardly grew in November, and government borrowing in the last 6 months was the highest in records going back more than 30 years. Chris Hare is an economist at HSBC Global Banking. Chris, with borrowing this high, the bond market reaction to the budget will be crucial. What are traders listening out for?
Traders are essentially looking out for, first, the extent to which Rachel Reeves in the budget will try to rebuild a degree of headroom relative to the fiscal rule. I think we're likely to see that. But most importantly, the extent to which the means of achieving that headroom, mostly through tax rises, is seen as credible. It looks like now we're seeing this smorgasbord approach to a couple of spending cuts, but mostly tax rises. And I guess the kind of things that could potentially concern markets if there's any of the subset of those measures turns out to be seen as not very credible, something that might run into opposition, then potentially we might see some volatility in markets over the coming days after the budget.
Now, Rachel Reeves has also got to balance fiscal prudence against the need for growth. Are markets worried about the lack of growth in the UK?
Yes, I think the data out this morning suggests that there's a bit of wait and see or cautious sort of behaviour, and maybe fears about the budget are feeding into that. And of course, it's difficult to stimulate the economy as a chancellor if you're having to undertake a big set of tax rises. From our perspective, one thing that one might like to see is that if you are raising taxes, hopefully there will be tax rate rises that aren't too front-loaded, but also potentially not too inflationary, as we've seen kind of recently in terms of previous tax rises. And if tax rises aren't inflationary, then hopefully that can get the economy onto a footing whereby inflation can fall back, the Bank of England can get going in terms of cutting interest rates, and that should hopefully bring about some support for private sector demand, which is something that we see happening over the next year or two.
Now, the market has more or less fully priced in a quarter-point cut from the Bank of England in December, but what could this budget and higher taxes mean for the bank going forward?
The dynamics of the Monetary Policy Committee at the Bank of England are really interesting. We've got 4 MPC members who want to cut rates, 4 MPC members who clearly, I think, want to stay on hold for the time being, and Governor Andrew Bailey has turned into an absolutely key swing voter. In terms of the prospect for a December interest rate cuts, it's going to depend on 1 more month of labour market and inflation data and the nature of the contents of the budget. So, for example, if we see downside news relative to the Bank of England's forecast in the inflation data, and if at the same time we see some quite front-loaded tax-raising measures, then absolutely we could well see a December rate cut. But what if we don't? What if the inflation data actually don't quite surprise to the downside? What if also tax rises are deferred a little bit? Then it's, I think, still not absolutely a done deal. In terms of our house view, we actually think the bank might just wait until February. But once rates do start coming down, we see inflation falling over the medium term, and actually we see multiple rate cuts through the course of next year.
Just how quickly are you expecting the bank to move in 2026?
Essentially, it's a return to 1 1/4 rate cuts, as we've seen more recently. In terms of our view, we've got 4% bank rates at the moment, and eventually we see 4 interest rate cuts, 1 per quarter, out to the end of next year. So you get to 3%. Gradual rate cuts, consistent, we think, with a gradual disinflationary trajectory over time. But the pace of those cuts could clearly change depending on exactly how big those measures in the budget turn out to be, and of course the data as they evolve over the coming months.
What does Rachel Reeves need to do to end up with sufficient headroom to hopefully silence worries about bond vigilantes for a while?
The reports seem to suggest that the government wants to go from headroom of £10 billion in the last 2 fiscal statements to £15 to £20 billion. Now, admittedly, that's not all that big in the grand scheme of the public finances, but nevertheless, let's say if you get to headroom of £15 to £20 billion, if tax raising measures to get there are seen as credible, then potentially you might, this is a big if, see bond markets settle at least for the time being. But the thing is, it's still not all that much headroom. So what if you see some new economic shock come along? What if growth more generally disappoints? Then the prospect of challenging fiscal events to come over the coming years, I think, is a real possibility.
That was Chris Hare of HSBC. Don't forget, you can watch more videos on Reuters.com.